Oh, traders, tech is out, financials are in. That's the title for today because we're seeing a large sector rotation, and I believe that for the next quarter, that sector rotation then goes on and continues. So I promise to get you guys out in just a few minutes. I'm going to make a quick video on some technical analysis right here, going over different areas of the market and how that affects the broader S&Ps. So first I want to take a look at the Russell. So we have an opening trade on the Russell so far, and right here we had a high, low, lower high, higher low, lower high, higher low, and they just kept on tightening up, tightening up, tightening up. And so it was tighter and tighter and tighter of a range on the Russell. We all knew it would have to break at some point. So it got tighter and tighter and tighter and tighter. And then it broke bullish. And the Russell is largely made up of industrials and financials. And we could also take a look at what happened with financials, and it's very similar. Taking a look at the financials, look at how they fell and then they barely recovered, versus tech, which recovered well over 100% of a retracement. So you're going to start to see the tech sell off now, as we're seeing, because it's gotten so overbought, and you start to see new leadership if this bull market wants to continue. And I think we're going to see that in financials because we have that high, low, lower high, lower low, confirmation of a downtrend, but then we didn't have any follow through. So then we just went a bit higher with the lower high, equal low, possible lower high, or possible trend change, high, higher low, and then we broke to higher highs. And so it's likely a trend change, and then we will likely come up here, pull back a bit, and then continue higher. But ultimately it's going higher because if we want to keep the bull market going, tech cannot hold the whole S&P up. And we're going to have to see financial step up, industrial step up, small caps like the Russell step up, and they already are starting to. The financials have made a trend change, small caps broke bullish, trend changed bullish. I want to take a look at QQQ, take a look at tech, and actually show you why tech cannot continue going up the way it is. So when taking a look at tech, it's not overbought on the daily, but if we actually zoom out weekly time frames, we can see that it got quite overextended to the upside, and that tech likely needs to take a break right now. And see if we can actually get out onto the monthly chart. And it's very overbought on the monthly, right here, overbought. But also on the monthly chart, look at what is happening right here. So this is 1, 2, 3, 4 months of action. And then this right here is another 4 months of action. Look at the 4 months of action right here, and look at the 4 months of action right here. We're in a situation where it's going up so quickly that the volatility is actually expanding to the upside, which is very rare. Most of the time, especially for tech stocks, volatility expands to the downside for these types of momentum tech stocks, yet volatility expanded to the upside. So it's got to have some sort of consolidation, likely a small pullback, and then just a sideways chop. The chop will likely not last that long though, but I'm expecting 2 weeks worth of consolidation, and right now I have an iron condor trade on because I just think that we will chop sideways for 2 weeks before breaking that range. So tech has got to slow down, but to keep the rest of the market up, because if we look at the S&Ps, what we'll notice is that the S&Ps have a double top right now. Looking at the S&Ps on the daily time frame, we have a double top forming right here. It's actually triple top at this point, and right here. And technical analysts will point to that and say that is the market top. And unless it follows through really quickly, that will become the market top. And so if bulls want to keep the momentum, which from what we're seeing they do, the financials and the small caps will start to come up, the mid caps will start to come up, and the tech and the social stocks, and let me actually show you the social stocks, they will start to have to take a break. Because if we look at these social stocks, we zoom out, weekly time frame, they just came down a little, but you barely notice on the chart because now they're a lot higher than they used to be. So even if you had invested right here, at what was the market top, you'd still be up quite a bit. And so these social stocks have to take a break too. They're getting very overbought. So you're going to start to see the sector rotation play out where the money starts to come out of tech, out of social, into financials, industrials, airlines, small caps, and mid caps. And then what about bank earnings? We just had bank earnings. It was very interesting. So bank earnings were relatively good. And they were bad for some names like Wells Fargo. And we can go on to Wells Fargo. Wells Fargo right here, as you can see, not too much action this week. It came down, but it's starting to recover. But it had the earnings. But for something like Goldman Sachs, it was very bullish this week. And the reason why we had the earnings that we did, and you got to understand a little bit about investment banks and retail banks and the structure and why they work the way they do. But the trading profits at Goldman Sachs market making areas were very, very high. And the reason they were is because on the options side, many of these pension funds and sovereign wealth funds, especially long only and mutual funds, were short vol. And the other side of that trade was taken by Goldman as the market was falling and as the volatility was increasing. And so Goldman got out on the right side of the trade. And as the market started to come down, they started gamma scalping it. They started buying up stocks. Because if I buy a straddle, I have a delta 0. As the market starts to come down, it turns into negative delta 10, negative delta 20, negative delta 30. So I'm going to buy to hedge it. I'm going to buy 10 shares, 20 shares, 30 shares. And so I'm going to hedge it. And so they're buying as the market went lower and creating that dealer gamma effect. And so as the market went lower, they were buying, but they still ended up making money because the straddle made more money than the amount they would have lost buying it. And eventually the straddle expired. And the money that they did have that was on the long book, that money then made money as the market came higher. And many, I suppose, and this is more so speculation, but I'm thinking that many of the funds that were short volatility lost a lot of money, and now volatility is very high. If we look at the S&P 500, the same exact place that it was right now back in February, the vol was 3 to 4 times lower, and that's because all these funds that were selling vol are now afraid to sell the vol because they lost when they were selling that vol. But Goldman, who takes the other side of those trades, makes markets and is the dealer for the short gamma players and takes the long dealer gamma. Goldman benefited from that, from making markets right there. And of course, when you make markets, you cannot have a directional bias, but when you make markets, you can have a volatility bias. And that's why Goldman was able to, they're able to make markets. They have to hedge out the delta. They have to hedge out the directional risk. And it's a regulatory thing. It's a risk thing, but at the same time, it's also a regulatory thing because if your client is, say, buying a certain stock, you don't want to take the other side and short the stock and have a short bias and basically work against your client. So they want you to be delta neutral and non-directional. But from a volatility perspective, they do take a viewpoint on volatility by reverse gamma scalping or gamma scalping being long gamma or short gamma. So that's why Goldman made money. Something like Wells Fargo, they lost money because that's more commercial banking than investment. Goldman is pretty much all investment banking, while Wells Fargo is all commercial. And commercial banks lost because interest rates are so low that they cannot make money on loans right now. And when interest rates were higher, even though they put out loans, those loans that they put out have solvency issues now. Wells Fargo works more so with small businesses. They work with companies that are more of your mom and pop shops. They work with individuals. And because of that, the money that Wells Fargo lended out, they're likely not going to get back. And if interest rates go higher even, the financials like Wells Fargo are going to get hurt because their loans that they got at zero interest rates are not going to make any money comparative to the loans that they could have then. So either way, it hurts the balance sheet, and there's a big solvency issue right there. And Goldman doesn't have to deal with that because Goldman largely works with higher net worth clients. So that's just what's going on right there with the bank's investment versus retail right there. Just give me a quick wrap up right there. And it's an interesting play. I'd rather be long the investment and short the commercial or retail banks. So right there, This is the main thing I wanted to get across, is that financials higher, industrials higher, airlines higher, or overall your tourism stocks higher, and your small caps and mid caps, these stocks that have been lagging. Take a look actually at some sectors. So I want to go back, I want to take a look at the IWM. Looking at this sector, got up, but then it failed. In mid-June, it topped out. Same thing with something like the DIA, topped out mid-June. But something like the QQQ, just continue to higher. So we see the money leaving tech and social, and we see it entering those old laggard sectors. And the laggards that we had previously for the last quarter are now going to become the leaders, and the leaders like tech are now going to become the laggards. And we are playing on that. And for QQQ, it's going to be an interesting setup to see what happens coming out of here. And I did write last July 14th, so on Tuesday, I actually wrote that we're going to see sector rotation, and this is in our newsletter that I wrote this, and I showed the NASDAQ 100, and I essentially said it's the NDX, so the cash, and there we go. We still have the drawing right now, and this is what I said would happen after it came down. I said, okay, there's going to be a sector rotation, and I know it. I was sure the day before that because I had put out a trade in IWM that was bullish, whereas on NASDAQ we put out a sideways trade. And now this made me even more sure, and I said, okay, it's gone down so much, and it has confirmed a daily downtrend on the daily time frame, but on the weekly time frame it's still in an uptrend, which really just means that you're going to see a bull flag or consolidation on the weekly time frame. And this is what it's going to look like. Here's the long-term channel right here, these two lines. And so you can see it right here, these two lines are the longer-term channels. And then right here, this is a short-term tightening range. This range where, because it got overbought, it's going to have some consolidation, it's going to tighten up. And so far, the tightening range is working very well. At the time, so I drew the tightening range right here. And the tightening range is starting to work out very well. It's just going to tighten up, and then eventually it's going to break either bullish or bearish. If it breaks bearish, I think that's less likely, but it's going to be significant. And it's going to be very similar to what happened with the Russell. With the Russell, going back, we had a tightening range, right? We went up and we tightened up for pretty much, I can say, week, 2 weeks, 3 weeks, almost 4 weeks. We just tightened up inside a range. I think we see something similar with the NASDAQ, where I'll go on to the NDX, where we just see this tighten up right here. Probably not for 4 weeks, but I would say for the next 2 weeks, we just see a range that's getting tighter and tighter and tighter, and eventually that range breaks bullish or bearish, and it will be significant. So you want to watch out for the NASDAQ. Sideways plays right there. The NASDAQ is a great place to be short premium right now, and it's a great place to be buying up the laggard sectors, using the premium from that to go long premium on the bullish side on the laggard sectors. Also, volatility. Vol is starting to come down, not as much though as it was before, but it is starting to come down. I would expect lower volatility, and that's another reason to be short some premium right here. I would love to be short some premium right here and sell some options because vol is still pretty high, and all those funds that were selling volatility in February and March, they have stopped selling volatility, but they're starting up a bit more now. The CTAs and vol funds, they are starting to position themselves in such a manner where they are starting to become short vol. So I'd look at that right there. Other than that, if you guys have any questions, go ahead and put them inside the comment section below. Hopefully I didn't take too much time, a couple of minutes, to explain all this to you. Thanks for watching, everybody. Happy trading.